It's a good start, good market breadth, good in terms of all the decent parameters which we always look at in trying to judge the market action. You want to start with the newsmakers, you want to start with Polycorp, you want to start with Wipro. Let's look at HCL Tech, Infosys and TCS. I mean, it's Polycab is bouncing back, expected lines. HCL Tech is off to a great start. And Wipro ADR was up 18%. I doubt it will be that kind of a spike. Let's see for Wipro to land up. No, it is actually 10% higher, not as much. I mean, never thought that Wipro is going to be the one which will come back and make everyone really excited. So Infosys and Wipro, which have been the laggards in last 1 year, are the ones which are making a comeback. It's been a case of extreme positioning where everybody was on the same side of the boat. Everyone thought that IT is not going to make a comeback. It's made a comeback. So Nifty above 22,000 for me. That is the headline, at least this Monday morning.
Oh, well, yes, it's got a very nice ring to it. NSE's new pin code, it's 22,000. We are sustaining above that mark, 22,026 at the frontline index level. And we've managed to scale that 22,000 mark. Of course, we had seen a big run up. We have been hitting record highs in the month of December, January as well. And now we are continuing that trot. Sensex too has managed to hit that 73,000 mark. So it's not just Nifty, it's Sensex also giving it. Company and small cap and mid cap have, as it has been, hitting fresh highs on an everyday basis. So that momentum really continues in today as well. Look at that market breadth, 1800 stocks advancing to 200 stocks declining, and that tells you the kind of momentum that we are seeing in the market right now, climbing all wall of worries. Sectorally, no doubt it's IT which is leading from the front, and the top 4 contributors for the Nifty right now are coming in from the IT index. But Reliance too has managed to open with a gap up of almost 0.5%. So we are seeing a bit of reaction there. In terms of the other movers, you have MRPL that continues its stellar run. On Friday, we had seen MRPL was up 14-15%. Today it's higher by 6%. Just style a result reaction coming in. We also have Prestigious State which continues to move higher. LIC is up 3%. BHEL on that 15,000 crore order win is also fairly excited. On the losing side, just watching out for Amber as well as Supreme Industries. These are a couple of counters which are opening up in the red. But volume-wise, it's Tata Consumers as well, which is perking up. Not a big rally, but just around 0.9% gains coming in for Tata Consumer. But Kunal, what do you make of this market move? 22,000 scale, and looks like we are not selling out in a hurry. We're just sustaining around that.
Yeah, looks like. And I also was looking at the kind of large cap names which are making a comeback from their initial opening high. So Infosys is moving up higher. You've seen HDFC Bank also, I think, coming back to the day's high. So hopefully if the private sector banks make a comeback, we could see a second leg of up move. But the stock which I would look to trade in the open would be Reliance Industries. After that excellent last week, in second half of last week, up move for the stock, it still looks attractive at this 2700 plus mark.
Sanjeev Prasad joins us. Let's time to say hello and good morning to him. Sanjeev, India or Singapore?
Singapore for now.
Singapore. Okay, wonderful. Let's understand first the market setup. If one looks at the setup, flows have been okay, global cues have been decent, and markets have got a surprise from IT in terms of the management commentary. So how would you assess the market setup right now?
Two ways to look at it is, on a fundamental basis, probably 90% of the market is overvalued, and you can start with the very large cap names which seem to be more reasonably valued. But as you go down the market cap quality and risk curve, the extent overvaluation keeps on increasing, and you can't even understand what is happening in some of the mid cap and small cap stocks. So anyway, let's not go there. If you look on a sentiment basis, clearly things are pretty positive now. There's a lot of excitement and euphoria. If I look at the setup, as you said, all the indicators are pretty positive in the sense that if you look at the macroeconomic parameters of India, everything looks good in the sense, growth, current account, BOP are looking pretty decent, and inflation and fiscal deficit, although on the higher side, they seem to be moving in the right direction. There are absolutely no concerns over there. Global setup is also good in the sense, we will probably see some rate cut over the next few weeks or months. and that can only be positive as far as sentiment is concerned. So broadly speaking, everything looks good. Long-term story of India is anyway very good. Earning numbers this year, Nifty 50, we are looking at about 18%. Having said that, a lot of that is coming from strong gain in net profits of BPCL and HPCL. But even if we exclude that, numbers are not that bad. And for next year, we're looking at somewhere about 12% for the Nifty 50 index. So broadly speaking, everything looks good. Incremental news is positive, and that's what the market is focused on. There is hardly any focus on what the stock prices are factoring in. And that goes back to the fundamental point, that if you do a more bottom-up first principle valuation of many stocks, they would probably come out to be the prices will be far ahead of whatever is the fundamental value of many of the stocks.
Sanjeev, I'll talk about something specific here, and which is a stock which you've tracked for years. I mean, I've seen you attending Reliance analyst meets right from 2000 or 2001 onwards. How would you view Reliance from, sorry, are you saying something? 2001 se, I have been attending them with you, so I don't know before that if you went there.
Yeah, I've been there since the previous millennium, actually.
Oh, great, great. See, I've started my career in 2000, so 2001 onwards only I've seen you. So I'm slightly late in, joining you there. Okay. But still, man, I mean, 25 years plus you've been tracking Reliance. Okay. What is your understanding of where Reliance is headed? Because it is at a very interesting juncture right now. Retail is firing full cylinders. New energy capex is, in a sense, bottoming out. Exciting things are happening in the geo and geofinancial services. Will 2024 belong to Reliance as a stock?
To make forecast about stocks and stock prices, but Reliance is probably in the camp I was referring to earlier. The mega caps where valuation seems somewhat more reasonable. So if you look at more bottom-up valuation, current valuation doesn't look current stock price does not look too far off from whatever should be the fundamental fair value of the company. You do a simple math this way, if you look at the old energy business, the company should do about 70-75 rupees EPS without assuming any big increase in either petrochemical or refining margins. You give about 10 times multiple for that export business. So you get about 750 rupees. That's the fair value of the old energy business. If you look at the telecom part, assuming some modest price increases, that is ARPU increases over FY25, we're looking at somewhere about 30 rupees EPS for the telecom part as per number of shares of Reliance. You could argue for about 25p for the telecom business, given that ARPUs will still grow from 2025 levels and data usage will continue to grow. So that gives another 750 rupees for the telecom business. Reliance retail should do about 17 rupees per share of Reliance as per our math. Now, depending on what multiple you want to give over there, and obviously the market mood is pretty positive for retaining stocks for now. So even if you give, let's say, 60, some of the stocks in retailing are actually much higher. You get about 1,000 rupees for the retail part. So broadly speaking, you can justify 2,500 quite easily just based on the three businesses. To add, to that you add whatever that you want to give for the smaller businesses of media, plus whatever land bank the company has, plus whatever option value you want to give for the new energy business. So in that sense, it doesn't look too bad. On a basis, at least you can get somewhere close to the market price, which is far from the case for many of the large caps and particularly the mid cap and small cap names.
Fair point. In 3 years, is there in 3 years, if you have to look at the construct of the Nifty, in terms of the weightages, what could enter in, what could come out, where do you think large amount of earnings would likely to move? How would you position that? Do you think that financial will gain more weightage? Are there new entrants which could come in terms of contributing to the total picture of Sensex and the Nifty?
I would assume so, at least since we're talking Reliance, assuming a listing of Reliance Geo slash Telecom and Reliance Retail, let's say over the next 2-3 years, I assume those companies will also list. And given the likely market cap, obviously there would be short entrance into the Nifty. I assume some other smaller names like BPCL, UPL, they probably get will probably get knocked off from the Nifty. But on a more longer term basis, you would probably see a lot many changes. Given the fact that as the discretionary spending ability of Indians go up, obviously the index has to start reflecting that. So I would assume you would probably start seeing more of healthcare services, insurance, and retailing companies coming in. We can just draw parallels from let's say economies which are further down the development curve as India, and you can take a cue from there as to what kind of companies are there in the main indices, and probably that would be the case for India also. The one of the things you need to keep in mind is whether the multiples will hold up or not for some of the current stocks, some of the current market favorites. Given the fact that obviously the Nifty weightage reflects the free float market cap, and given the likelihood of derating in some of the stocks as we look through the next 2 3 years, I assume the current state of euphoria will not come in, and really the market is ignoring some of the medium-term risks which will emerge in some of the vectors. I mean, they're already there. It's just that the market seems to be ignoring many of the risks. So you will probably see some lower weightages for some of the current favorites in the main indices.
Sanjeev, last year was all about PSU re-rating. Do you think this year it will be all about private banks, because that's the only pocket where valuations seem a bit more reasonable and the earnings have been quite steady?
Again, very hard to say what the markets will do. On a more fundamental basis, yes, it's possible that you could see some convergence between price and value as far as the broader market is concerned, uh, which could result in a fair amount of rating for many of the stocks which have gone up without any rhyme or reason. But I don't know the trigger for that. It is possible also that the current state of affairs could continue. That is, in the sense, you have a big divergence between the price, which is clearly the higher side compared to value. So I don't know, whether anything will change as far as the market is concerned. The sentiment is still towards momentum. So it is possible that whatever worked in the in the last 6 months of last year would probably continue for the next few months also. But I don't know whether there's current state of massive disconnect between price and value for most part of the market should logically continue. At some point in time, you should see some convergence between fundamental sentiments or value and price. But I don't know what's the trigger for that.
Morning, Sanjeev. What's the outlook when it comes to the assessment of earnings estimates and growth projections?
Well, everything looks pretty decent over there. So if you look at our GDP forecast for the current financial year, that is FY 2024, we're looking at 7%. You could possibly see some upside risk over there, given the fact that the first half was much stronger. And also, whatever advance estimate is coming from the government points to higher numbers. Same way for FY 2025. Currently, we have 6.3. It is again possible, assuming you start seeing some amount of recovery in both lower end consumption segment, hopefully some recovery in rural economy, and we can get into details of that later on, and also private sector capex recovery. Hopefully the 6.3 number could be exceeded. If you look at our earning numbers, as I was saying earlier, for FY 2024, we're looking at about 18%. Although 30% of the incremental profits come from a big rebound in earnings for BPC and HPCL. HPCL is not in Intel directly, but it's part of ONGC. For FY 2025, we're looking at about 12% for now. But if I exclude energy sector, it's actually 15%, and it's actually pretty broad-based growth across sectors. You could possibly see some upgrades also in the case of the banking sector for all, because we already assumed a pretty decent decline in the NIMs and some increase in credit cost. If that doesn't, come through, then you could possibly see some upgrades also there. So yeah, so the macro setup looks pretty good. Earning momentum looks good. I don't see any reason, any cause of concern over there. It's just the fact that the valuations are so stretched for many sectors and many stocks that it's just very hard to get your head around some of these numbers now.
Okay, Sanjay Prasad, really appreciate your time and so glad you could join us. And HCL Tech, well, the numbers came on Friday last week. Just a coincidence that All four IT companies came out with numbers in a matter of less than 24 hours, and the market reaction to first Infosys and TCS and now HCL Tech and Wipro, I guess, has been extraordinarily strong. So here's what the management of HCL Tech, which is Pratik Agrawal, Chief Financial Officer, Mr. Ramachandran, Chief People Officer at HCL Tech, and they both are now joining us to get a sense of where things are actually headed. Pratik, the company recorded a strong 32% growth in the PNP business. Want to understand that was there any one-off or this was bunching up which actually fueled the growth?
No one-off. Actually, that is the inherent seasonality that we have in the software business. It all depends on which customers and how many of them we are in touch with during that quarter. This business has 7,000-8,000 kind of number of customers. So the seasonality is dependent on the number of customers that have their renewals coming up in this quarter. And every December quarter is a seasonal high, as was this quarter. So that is the reason we publish not the sequential. I mean, we do give that data point there, but we always talk about year-on-year growth, which also for this business was a hefty 5%, which is very good in this environment and certainly for this business. So it was really the highlight of the quarter from a overall company perspective as well, because that led our total growth to 6% on a sequential basis, and also delivered 2-year high of 19.8% on the EBIT margins, because that's the most profitable segment we have.
Right, Pratik, I'm going to come to you again and understand what the contribution is of ASAP and Verizon in the services segment for the company.
Right. So we don't call out customer-wise numbers for obvious reasons. And suffice to say, that was the largest driver for the growth, the Verizon deal I'm talking about, which is, of course, organic. ASAP, which is inorganic, contributed full 3 months revenue this quarter compared to just 1 month in the last quarter. So that gave us about 1% increase on a company basis. So our 6% sequential growth on an organic basis is 5%, which is also very good.
Yeah, 5% organic growth is not bad at all. But let me bring Ramachandran also into the conversation. Ramachandran, if you can break it down, because you are one of those only IT companies, at least the tier 1 IT companies, that's reported an increase in the headcount versus the rest of your peers, which have actually reported a decline. Could you talk to me about what was the contribution here as well in terms of the ASAP acquisition? Did you take more hires from there, even for the Verizon deal? And what was the actual gross hiring that the organic business did?
So, so far as ASAP deal is concerned, that was in the last quarter itself, last month of last quarter. So that numbers were already there in the JAS quarter. O&D quarter, obviously, there was a significant contribution from the ramp up that we had to do for Verizon. Gross hiring numbers, we're not talking about gross hiring numbers, but if you look at the net addition this quarter, after 2 quarters of negative net addition, we had 3,600 plus positive net addition this quarter, which is to a large extent contributed by the ramp up for Verizon, which is clearly the mega deal in this quarter.
And just to add, we also added 3,800 odd freshers during the quarter. So we continue to hire freshers every quarter and have not paused that engine.
Ramachandran, going forward, what is the expected headcount and additional rate for Q4 FY25?
So Q4 will continue our hiring trend for Q4 to support our growth. We have projected growth for Q4. So our lateral hiring will continue for Q4. Again, fresher hiring, we continue to honor our commitments for onboarding. So we will see fresher onboarding happening in Q4 as well. So net, we expect Q4 to be a net addition to our headcount. FY25, it's early to talk about FY25. We will be finalizing our plans in the coming weeks. So far as Q4 is concerned, we expect net headcount growth, both contributed by fresher additions for this quarter, as well as ongoing lateral hiring that we do. So we expect the momentum to continue from this quarter into Q4 as well, so far as recruiting is concerned.
Okay, let's also get in a sense then, Prateek, from you, because despite the strong margin show, the EBIT margin guidance has been maintained between 18 and 19%. Any headwinds in Q4? Are you confident that you can deliver closer to maybe the upper end of the guidance? Because we do understand that some part of the salary hikes even may trickle in into Q4. So are you seeing any impact then of that?
So there is no headwind per se, but the seasonality that I talked about right up front in the software business, that seasonality comes off in the next quarter. So just like we saw 100 million kind of increase in this quarter in the revenues of software, December quarter versus September quarter, March quarter typically tends to be lower, and that again, just like the higher revenue has flown down to the profits this quarter, the lower revenue the lower margins in the software business will be there again as per seasonality. So that is what needs to be factored in. And the salary increments that you talked about, the second phase, will not be too much is what we expect. It should be around 25 odd basis points kind of a number. So I think we continue to have a good margin story for the full year. September quarter was a great quarter, so was December, and we look forward to close the year at a good clip.
Okay, ending the year at a good clip, but then does that mean next year it will be a faster clip and we'll see that 20% margin figure finally? What's your take, Prateek?
I would certainly wish for and hope for that, but in the medium term, as of now, we are sticking to 18 to 19, and 19.8 was the seasonal high in the December quarter. For the full year, we expect ourselves to be somewhere in that 18 to 19 range, and our aspirational margin band continues to be 19 to 20, around the number that you talked about. But in the medium term, as we come out of this slower growth kind of phase that we have been going through in the last 12 months and beginning to see some green shoots now.
So Prateek, what is this time when it comes to deal wins, because we are on the lower side, do you think that you would attribute it to the seasonality factor? What's the broad quarterly range?
I think our range for the deal wins has, for the last almost 8, maybe 10 quarters now, is around that 2.5 billion. So average sort of comes to around 2.2 or something like that. Last quarter was an exceptional quarter where we booked almost 4 billion, which was 3.9 to be precise. And that was, 1.8 billion of normal other deal wins, and 2.1 came from the large mega deal that we announced. So comparing against that, almost all-time high kind of a number would be unfair to this quarter. And if you look at it, December quarter, because of the holidays and because of the second half of December being a little light, has a little bit of seasonality, but I think it continues to be in that 2 billion-ish kind of range.
Sure, Pratik, but any sense is the overall discretionary environment now improving? Because that's the big question, and that'll, decide whether in FY25 we'll see that double-digit growth come by or not. What's your take? Will FY25 be better than FY24? Will we come back to that double-digit growth mark?
We certainly hope for better discretionary in the FY25. Unfortunately, as of now, we are not able to call out any major swing. We are seeing some green shoots in our ER&D business. ER&D, even outside of the ASAP numbers, showed a 2.5% sequential organic growth. And even last quarter, they showed 1.6% organic growth outside of ASAP. So we are seeing some green shoots there, but in the IT and business services, which is the larger segment, we continue to wait for discretionary to really come back in a big way. Fingers crossed.
All right, and Pratik, BFSI has declined. The manufacturing as well on an organic basis seems weak. What about the internals when it comes to the various business segments?
I think, the right way to look at this metric is the year-on-year growth, because that factors in the seasonality. And you talked about BFSI. So this is the one vertical where the furloughs during the December quarter are the maximum. And therefore, that -1% that you see there is basically because of that. But if you look at it on a year-on-year basis, because the furloughs were there in the previous December quarter as well, that is a very healthy 12.9%, which is quite market leading, especially in this environment.
Sure, point taken. Thanks so much for making time and speaking with us, gentlemen. Appreciate you joining us on the show. The stock is reacting positively. It's up around 4% in the trading session. But the other stock and the other space which is on our radar right now is Alcobev. A lot has been happening, and of course, a lot of these Indian-made whiskies and liquors have been getting a lot of recognition across the globe, and we have the latest feather in the hat in the sense of what Radico Khaitan has managed to bag in terms of an international award. We'll discuss more on that with Mr. Sanjeev Banga, the President of International Business of Radico Khaitan, joining us on the show. Hi, good to be speaking with you. I just wanted to first up congratulate you on the Rampur Asava, which has won the Best Whiskey Award at the John Barleycorn Awards in 2023. Talk to us about what really distinguishes what Indian liquor industry is doing right now, and specifically for Rampur Asava. How is it different from the other whiskies in the world?
Good morning, and thank you very much for having me on board. Let me wish you and your loved ones and the viewers of ET Now a very happy new year. The beginning of 2024 has been fantastic for us. We've just won the Best World Whiskey for Rampur Asava at the John Barleycorn Awards. So what we've tried to do since we launched the first expression of Rampur Indian Single Malt in 2016 is to offer something unique, something very different, something very Indian. And in fact, for Rampur Asava, we went a step ahead. That's the first single malt in the history that's been finished in an Indian red wine, a Capsoft cask. So what we're trying to do is there are single malts all over the world. There are a number of them, even from India. There are quite a few single malts, but we try to be a little different. And the beauty is all the malt connoisseurs are always looking for something which is different, unique, and very, I would say, palatable. So that's been the biggest advantage of the entire Rampur range.
Okay, fair enough. Now, can you give us a sense as to when it will be available in the Indian market now that the global acceptance has come? What kind of a response you're expecting from the domestic whiskey lovers?
Well, honestly, Rampur's been strictly on allocation. Our brands are available in over 100 countries today, but Rampur, we've restricted the allocation to only about 39, 40 countries. Also within India, it's a limited exposure allocation so far, limited to about 14, 15 cities. But we tripled our malt capacity a couple of years ago. So a lot of malt, which is underaging, will be ready for bottling this year. And we plan to extend the range of Rampur Indian single malt in India as well. And Rampur Asava is the one that will be launched very soon in the Indian domestic market as well.
Sure, point taken. So that's the latest coming in on when it will be available in the Indian markets. But as it is, your export presence has been quite strong. You export to over 100 countries. But if I look at the contribution in terms of value to the total business, it's still single digit. When do you expect it to ramp up, and what is the overall scope that is there in terms of exports for the company?
Well, in terms of our revenue or the volumes, the exports would account for about 6 to 7%. But in value terms, it's more than 10% over here. And as we expand our luxury portfolio, which is of Rampur Indian Single Malt, Jaisalmer Indian Craft Gin, and Sangam World Malt, we expect the value terms to keep on increasing. And with the enhanced capacity, we are expecting Rampur to keep doubling for the next 3 to 4 years. So that will definitely add more value to our overall business. In terms of expansion, Indian domestic market is a priority market, but then also our existing markets, which include US, UK, Europe, Singapore, the global travel retail. So we will definitely increase the allocation for these markets as well as open up new markets. So the future looks very bright for our luxury portfolio.
What about the kind of election-led volume growth you're anticipating over the next 3 to 4 months?
Well, that's a domestic domain, but you expect more, as we've seen always in the past as well. But that's more in the regular and the semi-premium sort of category. The luxury portfolio doesn't get impacted that much with the elections. But it'll be definitely good for our rest of the IMFL portfolio.
Note, we let you go. Thanks so much for making time and speaking with us. But in the meantime, taking stock of what else is happening in the market right now. A lot of big buzzers on the gaining side, of course. You have IT, which is again doing quite well for itself. You also have IRFCL, which is up around 15%. MRPL is trending higher by 14%. Wipro has actually cooled off a bit. So that stock is now 9% higher. So I'm calling it a cool off because it started with a 10% gain. So from there, we are seeing a bit of a retreat. Nugent Software is the other one. DB Realty is the other stock we're watching out for. Tech Mahindra too is actually gaining ground. Of course, that company hasn't reported its numbers as yet. But just the expectation of a bit of a reversal is something which is firing away all of these IT counters. On the losing side, Supreme Industries is down 4%. JBM Auto, Dixon Tech, HDFC Life as well is cooling off a bit. So just watching out for some of these names in the trading session right now. But let's move on. In fact, in an 18 Hour Top Market Voices segment, let's decode the market move and let's also try and understand what's next for India. We're asking the question as to how the global trend is impacting India's story as well. Ajay, actually, my colleague, spoke with Shailesh Bhan of Nippon MF, S. Narain of ICICI Prudential Mutual Fund, and SBI Mutual Fund's Srinivasan Rama Iyer during the CFA India's 14th conference. Listen into a slice of that conversation.
See, internationally, there are so many moving parts that it's very difficult to say where it stands. It's clearly, it means that the volatility reflects, or at least the unidirectional movement reflects that clearly a lot of it is getting priced in. We don't know the degree of it. And neither does it reflect on the fact that it will immediately correct. None of these lead to that conclusion. In India, clearly we are finding that expectations are running very high. And I think, so whether we are in terms of scale where we stand, but clearly we are getting into a zone where you touch a stock, it goes up. You don't need to read about it or invest or whatever, or you think about it, it goes up. So that is a reflection of, I would say, starting of excesses, which is there now for the last few months. Money flows are unidirectional. Everybody's turned into or everybody has a stock idea today. So clearly we are getting into that zone, and that is where I think a little bit of risk averseness will help all of us.
Great, you are spelling out caution. That's a great starting point. Vasu, just to put the global things also in perspective, from the peak of pessimism, COVID lows, there's a lot of things happened. Geopolitical issues, in the Middle East, slowdown issues in the US. China is not doing that great, but markets globally have been climbing, not all markets, but largely this wall of worry. What do you make of the backdrop, global backdrop in which India is operating right now?
I wouldn't have been able to predict this if you had asked me this question.
Say 2 years
and if
back.
you had 2 years back, and if you had told me there's going to be a war and all the uncertainty and rates would have gone up to like 5%, I would have definitely been negative on markets. So I think the only thing that explains it, I guess, is the huge liquidity around.
Because I don't
That's
remember a
true for
time
India
when
also.
war is going on simultaneously, market is running globally. As if everything is getting priced in. And the global asset classes are moving in individual silos, and a war in the Middle East did not really impact for a prolonged period of time. It did impact for some time temporarily, but then market moved on. So how did you react at that time? And were you also, your model also kind of you got surprised?
So it's easier for us to be very honest. So we are relative return investors, so we really don't bother about where the market is going largely for a very large part of the portfolio. We just put our heads down and try to figure out what stocks or sectors will do well within that frame. So that makes our job easier. But having said that, we do have a market timing model on which we run a dynamic asset allocation fund. That model has been negative on equities for like the last 18 months or so. And by and large, I would say that model has gone right because the underlying for that model is the Nifty. And till the recent rally, Nifty really hasn't gone, I mean, it's done like 5%, 6%. But what has really done well is the stocks down the capitalization curve. And the model doesn't try to predict that because the data there is not clean enough. And the model has been negative because while earnings are good, so we basically look at three factors: valuation, earnings, and sentiment. Earnings are fine. I think they're better than expectations for sure. Valuations, we look at something called the Schiller P. We look at the inverse of the Schiller P, and we take out bond yields from it. So that's somewhere in the 77th or 78th percentile. And when you kind of regress that with 3-year forward returns indicate an equity risk premium of like 1.25, 1.3%, which I think is not good enough. You need closer to 5.5%, 6%. And we also kind of put sentiment on top of it. So the sentiment index we run correlates very well with 1-year forward returns. We do that because markets tend to overshoot on the upside and on the downside. So you want to kind of time it right. So this model has been negative. It also, the extent to which it has been negative is, so on a 50-50 benchmark, it's been 20% underweight equity. And I think it's been fine so far. So I would say that to that topic, optimism or exuberance, right? So I would say that large cap space is probably in an optimistic zone, whereas I definitely think that the small cap, the micro cap space is quite exuberant.
Okay, so you're breaking it down in two parts and approaching the market.
Because that dispersion is very visible.
Very
so small cap index is done 50%, large cap is up like 17, 18%, 32% outperformance in a year. So,
Naren, the speed at which global fear turned to greed, when we topped out, say, 107 on the dollar index globally, or yields, from the recent peaks have fallen below the 4% mark. Were you surprised at which the sentiment globally also changed? That also gave a very big kind of boost to Indian equities.
Certainly, I think people have come to a conclusion equity is the only asset class which people like today. First of all, it's a liquid asset class. You can easily come in and come out. The trading engine is very good.
You're talking about global equities?
Yeah, even globally. So somehow what has happened is that people have found it very comfortable with equities as an asset class. And I think globally there are too many people who have short positions in too many stocks. So what happens is that periodically the shorts get squeezed And that also results in huge rallies these days. You know, there are these CTA funds globally. I think those funds manage to squeeze out all the shorts periodically. So I think, you know, there is all kinds of market positions these days, things which we don't know about actually, and that has resulted in a situation where it has become very difficult to predict markets at this point of time. And the kind of whipsaw moves that you have on small differences in results are something which you would have never expected way back, because of the fact that, you know, you have what kind of short position, who has the short position, we don't even know. And that is, so that's why I would say yes, we have been surprised, but we have increasingly got round to the view that there are a lot of people for whom this has been a long bull market in US, all the way from 2010 to 2021. So I think a lot of people believe in equities as an asset class. Even in India, if you look at it from 2013 onwards, most people have not seen losses. So people believe in equities as an asset class. So the confidence in equities is at a record level. That people don't want to leave the asset class. So periodically, what was trading at X?
So what people were trading at one point of time, they have actually changed. So slowly every PE, what you were giving X PE, you started to give 20% higher valuation. Now slowly you're giving 30% higher valuation. You're giving 40% higher valuation. I think every other boom continues, you'll give higher and higher valuation. So then the market boom can sustain.
What is your view on this argument which comes up that some of the reason for India's strong outperformance is actually because of the superior economic growth over here and structural reforms which have been taking place versus many other large liquid markets globally?
Absolutely. I think the macro has been handled very well over the last decade. If you look at current account deficit, for example, has been very well behaved. Inflation has been very well behaved. The interest rates in India are much lower than where they were 10 years back. So on all those counts, there is an argument for value for the entire macro to be good. While macro is good, increasingly, you know, to what extent you will pay what valuation. Because if you look at many parts of the economy, there are many sectors in the economy which are growing much slower than before. But while those sectors are growing slower, you're giving now higher valuations. So yes, the macro is good, but how much extra valuation you'll give for the macro? That is the challenge that we as investors. So to the extent you can forget the past, it's easier to manage money. And how much you forget the past, because finally the past will come back. So that is the challenge that we have when we have to look at investors' interest when you are managing the money.
Yeah, and they say about history that the only thing we learn from history is that we don't learn anything from history.
Exactly. So if you ever had a mindset of looking at a company with a pre-2013 lens, it would be very difficult to invest in any stock. So you have to have a new lens. Whether that new lens is a wrong lens or not, you'll come to know, and that's the challenge for us at this point of time.
Sailesh, you know what happened was that from a time, say 2 years back, there were some economists out there who were saying that India will be lucky to have 5% kind of growth. The kind of numbers which we saw surprised majority of the investing population in universe. Does the economic growth which we've been posted in the last 2 quarters, say, does it appear sustainable or prolonged to you?
Clearly, growth rates are improving, right? So the debate on valuations is more that whether that all that
how much
growth
of that is priced in?
Yeah. So growth rates are improving clearly, and despite the world being in bad shape, we are coming back. Only worry is, you know, the revenue growth hasn't kicked up so strongly. It's more coming from margin expansion, from generally sharp fall in raw material prices versus what was the case 12, 18 months back. So the base effect is flowing in. As revenue growth starts kicking in, which I think is possible in the next 1 or 2 years or a few quarters ahead, I think things should get okay from a growth point of view. But we are already paying for, at least in a lot of pockets, like, you know, the small and mid cap kind of sub pockets, we are certainly paying well. So there cannot be any room for error. There cannot be any disappointment, which is, see, today it's a belief of certainty. So investor is writing a check with a certainty of returns in mind, or at least the expectations are a little unreal. So that is where the word of caution. Broadly, markets can still do, earnings can still do well and things like that. That's not a problem so much, because balance sheets are good, reforms have happened, macros are decent, our currency is not fragile, at least as it used to be earlier. So it's much, much better from that angle, and the runway for growth can certainly be long, but I think we are paying a little too
Already
upfront because
into
of
the
the
price.
flows which are happening.
Vasu, what are your thoughts on, two largest economies in the world? And, we have been kind of at the receiving end of volatility in commodity prices for a very, very long time. Corporate India suffers from it. We as consumers also go through those challenges. But the two large consumers, apart from us, for commodities have been US and China. Both of them are in not great economic shape. Does it give you confidence that the commodity universe will remain in deflationary trend for medium term, because that eventually will have impact on the raw material scenario for corporate India and hence will kind of cushion margins, China and US?
That is definitely one way to look at it, but we're actually bullish on commodities from a longer term perspective. Basically, the long term view is that because of the high debt to GDPs across the world, you are entering into a phase of, or a period of financial repression, and negative real rates will be positive for commodities.
All right, that was the view coming in, getting in a sense as to how the top market voices are looking at the road ahead for India. 21,960A, that's where we're at for the frontline index. It's tempered off when it comes to the broader universe, so as we speak, mildly in the red. And looking at the individual sectors then, while you do have IT, which continues to remain a driving force, some of the other sectors have lost a bit of sheen, metals, auto for instance, and even media is lagging with a 1% cut. But let's move right on and talk a little bit more about FDIs in terms of what's ailing Indian FDI flows and whether or not we can see the long-term fundamentals intact, or whether or not there's a slowdown. Pranjal Bhandari is the Chief Economist, India and Indonesia at HSBC, and now joining us on the show. Thanks so much for taking the time out. Just going by the latest reports, can you give us a sense as to what the outlook is in particular when it comes to the overall FDI flows, historically, what we have witnessed into India, what the last 4 quarters as well have reflected?
Yeah, sure. So I think this is a very interesting topic because, all around the world, there's a buzz about India on how India is growing. Its growth obviously has been stupendous over the last couple of quarters. And India is also gaining global market share in the trade of goods and services. So then it becomes a real mystery if you look at foreign direct investment into the economy and you notice that in the last 4 quarters, it's actually halved. It sort of just doesn't add up with the rest of the commentary we are getting on India on many other fronts. So what's really going on there? And I think that's something that I've looked into in a lot of detail.
Yeah, and what are the key findings then, Pranjal? What explains that dichotomy? I mean, is it just flowing into certain sectors? What's the reason that we're not seeing the actual flows come in? While, of course, as you said, there's a lot of chatter across the world.
Yeah, so look, India's FDI rose, over the last 10 years and then dramatically in the pandemic period. And now it's halved, as I said. So what we do is we look at a lot of foreign investment intentions. You see, corporates, they talk about their expectations and their intention to invest, and then the investment happens. So we track the very early data, the intention data, and we find that there's a huge shift going on, a shifting of frontiers in the background. So when FDI really rose in the pandemic period and we were getting $555 billion of FDI per year, it was a lot of pandemic heavy sectors like computers, electronics, chemicals, drugs and pharmaceuticals. But that era is now over. If I look at intentions data, there's a huge shift happening from pandemic to futuristic sectors like AI, EVs, green hydrogen, renewables, data centers, and things like that. So we're seeing a huge shifting of frontiers that is going on. But because these are new sectors, things like AI and EVs, it takes time, for the money to really flow in, and that I think is what's causing the delay. In the past, whenever we've grappled with new sectors, it takes about 2 years. And my sense is this is that 2-year period we are going through where these sectors are getting ready to welcome new FDI. My sense is a new FDI wave could begin but it'll take about a year. But when it does begin, FDI inflows will double. It's fallen to about $27 billion right now. It'll go back to $55 billion a year, which is what we had seen at the peak during the pandemic.
I wanted to understand from you as well. I know you spoke about the individual sectors, but how are you looking at the futuristic sectors bringing, an ease of business and a new wave of FDI flows? If you could just characterize a little bit more about some of these newer sectors, AI, EVs, renewables.
Yes. So look, there are these sectors, which we are all talking about. India was the largest beneficiary of AI-led FDI in the world last year. A lot of people don't realize that. So we are really in the forefront of this. We want to become a regional hub in green hydrogen. We are trying to develop our own EVs ecosystem right now, more in the two-wheeler space. We are pushing hard, on all kinds of renewables, solar panels. So a lot of these futuristic sectors are some of the priority sectors in the economy as well. But I think taking a step back, what's also important is the partners we are working with. Who are the people, who are the countries who are putting money into India? And there we are seeing a big rise from Middle East and the US. So FDI from the Middle East has been growing at about 60% CAGR in the last 4 years. From the US has been growing at about 45 to 50% CAGR in the last few years. We're also seeing renewed interest from sovereign wealth funds. For instance, we dial back to COP26 a couple of months ago. The Abu Dhabi Investment Authority, they had this huge intentions of investment into renewables, and India was one of their key focus. So we are seeing new partners, Middle East, US, and Abu Dhabi. So all of this is a great story, but it is not that simple. India will have to prepare itself to be able to receive these inflows. In the past, we've seen whenever we've seen big inflows, it's happened in just one or two sectors. India is very capable of getting money into one or two sectors. It's very well oiled. But as soon as we try to get money into lots of different sectors, particularly new, then we do face a lot of ease of doing business issues. For example, licensing delays, regulatory issues, and so on and so forth. So if India can get that right and really make it easy for big companies to come into the economy, I think they are waiting to do so. At least that is what their intentions, are signaling.
Pranjal, are you saying that there's still a lot of policy action which is needed? Because, in terms of the FDI regulations, in terms of that entire campaign by Invest India, at least it seems like we're a lot more open to get the foreign capital. But are you saying on the ground, when you have to, let's say, set up the industries and get all those approvals, is that still a very real challenge that's concerning the foreign investment?
Well, look, in the past, we have seen that in periods when there is intentions across the board, money does not flow in a big way. So, of course, there are a lot of hiccups that happen. They probably are sector specific, country specific, and dealing with new sectors always creates some friction. My point here is that if we can be cognizant that these have been frictions in the past and can clear the space for these futuristic sectors of companies who really want to come into India, then India can actually be a big beneficiary. But we just have to work hard on it. We'll have to make sure licensing is quick. We'll have to make sure that the regulatory burden is not too bad, as in a lot of stuff happens parallelly, happens quickly. And I think if we can get that right, we have a lot to gain, because a lot of companies want to invest into India now, much more than I've seen in the past.
Talked about how we have new partners in place, the entire Middle East interest and all of that. But I also want to touch upon the manner in which the money is coming into India. Is it, more in terms of the equity investment into IPOs and the direct, capital markets? Or is it happening more at a basic level where they themselves are setting up? Or is it a lot more partnerships and tie-ups? Is there any breakup of that data available as to the nature of the flows?
So, I think all of the above. But what I find useful is breaking down FDI into digital inflows versus physical inflows. We've seen a rapid rise in both in the pandemic and a rapid drop in both after the pandemic. My sense is digital inflows are easier to explain. During the pandemic, there was a big wave of startup funding around the world, VC funding, and India also gained a lot there. But then after the pandemic, because of the interest rate environment, because of global liquidity being tight, this money actually fell for all the countries, and India was just one of them. So basically, India followed the global pattern when it comes to digital FDI. But in terms of physical FDI, it's a mystery, which we've tried to grapple with. That why is it that India's inflows for physical FDI has fallen far more than what we've seen in the FDI inflows for other countries. That has been the big problem. And that is where I looked at intentions data and I realized that it's a shifting of frontiers. We've moved away, the world has moved away from pandemic time sectors like electronics, computers, drugs and pharma, and is now moving towards futuristic sectors like green hydrogen, EV, and AI and all of that. So a big regime shift is happening. We'll have to be open for all kinds of money coming in, equities, direct investment, partnerships, because it's going to be all kinds. The big challenge is we have to be open for business.
Open for business, that's what we have to do. Thanks so much, Pranjal, for making time and speaking with us on this interesting topic. So FDI for now has of course fallen off the cliff, almost halved, but the big point is that the intentions are high. They are looking at partnering. We just have to beef up and open our doors for business, and then we'll see the flows coming back, because in terms of partners, we do have fresh interest from sovereign wealth funds, the Middle East countries, and a lot more to watch out for. But let's do one thing. Let's take a short breather on the show. There's a bit of a slip in the market, but we seem to have recovered for now. We'll track that when we come back. Welcome back, and you're watching the market on ET Now. Tata Consumers has made two acquisitions. One is Capital Foods for an enterprise value of 5,100 crores, and other is Organic India for 1,900 crores. Now, yes, to talk more about that today, in terms of we have the management and founder of Capital Foods, Ajay Gupta, joining in with us on the phone line. Thank you so much, Mr. Gupta, for joining in with us this morning on ET Now. And, I want to start by talking about the deal that has come in. Okay, 5,100 crores, 75% is what Tata Consumers has acquired right now, and the remaining will be acquired over a period of 3 years. So that remaining 25%, is there any specific criteria in terms of the performance that is required for the company, or is it just a process that will be happening, or what is the criteria there?
No, it's a process. It's a process that will happen over the next 3 years. We continue being the business to mentor the brands in the next 3 years. That's the whole idea.
Ajay, morning. Also, I just wanted to understand what the outlook is in terms of Capital Foods. Of course, the very popular brands that you operate in are known. That is Ching's Secret, Smith & Jones. But what kind of turnover have you clocked in for the year gone by? What kind of financials would you like to share with us?
So we've done around 870 crores turnover, and we operate at 55% gross margin. So we have a high gross margin. Our challenge has been growing distribution, general trade distribution in the country, and that's where TCPL comes in. With their distribution reach, we'll be able to multiply the business tenfold in the next 2 years. That's the way we see it.
Just you said tenfold is what you could grow your business.
In terms of distribution, correct. In terms of distribution.
Okay, in terms of distribution. Then in terms of revenue, obviously in the last 3 years, what we are looking at it in terms of the numbers that are there in the press release, that says around a CAGR growth of 20%. How much more upside do you see in terms of revenue, right? Obviously, if distribution is growing, where would we see the revenue headed as well? And what do you see in terms of growth trajectory that you have that one could expect then from Capital Foods?
So the way we see this is we've over the last 10-12 years, we've grown at around 20% year on year. We believe with the strength of the distribution of TCPL coming into play now, we will see upward of 30-35% growth year on year for the next few years. And that really comes out of distribution. And then one is general trade distribution. TCPL is very strong in e-commerce, which is an evolving distribution channel. So there's a lot of synergies that are going to come into play in the coming few months.
Some on the street, Ajay, are talking this valuation a little bit pricey. Can you just give us maybe your outlook on what the conversations were with respect to valuations, how you would really like to justify it?
frankly, from our perspective, these are very fair valuation to a business that is niche, was a niche that has evolved to become a mass distribution product. Iconic brands. As soon as the scale of distribution hits in, with the 55% gross margin plus the synergies coming into play, so we're looking at 300 to 400 basis point coming in further into the gross margin. So from that perspective, we see this as a really fair value that we got from the market, from TCPL.
You did touch upon a bit in terms of the gross margins and what you're expecting in terms of addition over there. But specifically in terms of EBITDA margins also, could you highlight in terms of the synergies that one could actually see, other than obviously the trade discounts, what are the other synergies that we could see on the margin front, if you could give us a perspective there?
So we operate through a super stockist in between. So that's a area that get cut off, and from the CFA we'll go straight to distribution. That's 3.5% margin that directly gets to the bottom line. Plus there are synergies in terms of why do we need two organizations. So there's a whole lot of synergies that will come into play here. There's a large part in the exports market as well, where Desi Chinese is large. We've been available in most of the large markets, but TCPL has their own offices and teams in most of the large countries in the world, and that also is going to add a huge value to our business.
Stand from you then, we're a little bit curious as to whether or not the growth outlook was looking promising, because you had gone ahead and said that you are growing very smartly. The growth rate is strong. So question is, why the exit then? Was it a lack of funds maybe? Was that a reason?
No, we are a profitable company with money in the bank. So ours was the two PE funds in the business. The funds needed exit. I'm also at 58, and I have nobody. I have daughters who are not interested in the business. So it was a long-term plan for me as well. At some point, I needed to take an exit. So it's really coming from there.
Okay, and Ajay, I just want to understand in terms of the positioning of instant noodles, right? That was not something that had picked up pace. So in terms of where is the positioning of instant noodles and what is the growth that one could see there? Given the distribution, do you think that's a synergy or a growth driver that could work out as well?
So we have been a distinctly different instant noodle brand in the country, playing in the flavor aspect of instant noodles. We don't do the typical masala, and we've been waiting for the market to change, and that's what's happened. There's a huge premiumization on instant noodles that's happened in the last 1 year. We actually come into play now. We've been 15 rupees MRP against the competition being at 10 at some point, which is 50% higher price point. But we're seeing now that play coming into force. And with the distribution of TCPL, we also see a growth coming in instant noodle category. Though frankly speaking, we've not done a large play on instant noodle over the last few years. Our core has been the Szechuan chutney, the Chinese masalas that we've been aggressively growing.
Urban rural mix.
All right, good to have you on board. Thanks so much for taking time out and joining in. All right, that's the word coming in from Tata Capital, getting their take on the side of the transaction. Confident that, the business is growing at a very strong rate. I think he spoke about an 800 crore rupee revenue growth as well. And they expect to now grow 10x with the distribution from Tata Consumer Products. All right, that aside, let's connect with Kunal, talk about Chartbusters. Kunal, take us through your chart of the day.
Well, yes, Avan, it's L&T Finance, a stock which has been very slowly and gradually moving into a subtle uptrend. Now, interestingly, the last 3 or 4 months, the stock has moved from 120. at this point where the stock formed a major base for itself, 120 approximately. So this is on the spot levels for L&T Finance. From there, what started off was a very classical journey of the stock going into an slow, steady, gradual uptrend. So you've seen the stock making a pattern of higher highs for itself every time the stock starts to get into an uptrend. And even the lows for the stock has been on the higher side. So the previous low for the stock, which was around the 120 mark, moved up higher as a base from 120, 122, 125, 135 approximately. And the most recent low for the stock, or the recent swing low, was closer to this 160, 62 levels for L&T Finance. So a classical sign of the stock moving into an upward trend. Now what matters for the stock is again a very similar kind of a price trajectory, that whenever it gets into a breakout of the previous swing high, as we see over here, the stock gets into a strong uptrend. The previous highs become the support for the stock. We see that phenomena happening for L&T Finance even this time around, where the stock managed to break past about the previous highs, started off an uptrend, moved into at least a 10% rally, and then this previous high becomes a resistance. So now the previous high for the stock is closer to 175 mark. I believe that possibly in the next 1 or 2 weeks, we could expect the stock to scale past about this 175 levels, and this could act as a strong base for the stock. So for traders who are looking at a fresh buy, could look at a stop loss of 162 approximately for L&T Finance. Wait out for a breakout above 175. We could be looking at the stock hitting levels of even 190 to 200.
Okay, that's L&T Finance Holdings. That's Kunal's chart of the day. But let's get in your top picks as well.
So two buy calls. The first one is from the PSU banking lot. Union Bank is something which looks attractive. The stock is again finding good momentum for itself. So buy with a target of 142. Stop loss could be kept at 130. And second would be a buy on Hoodco. That's a stock which is given a consolidation breakout about 125, 127 mark. So keeping 124 as a stop loss, puts the rest a buy with 140 as a target for Hoodco.
Okay, so those are the top recommendations coming in from Kunal at this point of time. Tell you what, let's slip into a very short break. When we come back, we'll tell you about all the buzzers and the stocks which are in news.